And welcome to the show today. My name is Dave Plivelich. Before we get into today's episode, I want to encourage our listeners to follow us on Instagram at R2 Podcast. That's plural. We're on Facebook. We're on YouTube. Any place you can hear a podcast, Spotify, Apple, we're there. We can be found. New listeners, we really encourage you to go back and listen to some of our old episodes to catch yourself up. And a lot of our shows are evergreen, and there's always good information you can go back to. Kevin and Shannon, I'm so happy to have you guys joining us. You guys came to the Marcom Group's 25th anniversary. You got to meet some of the co-hosts, and I'm glad you guys were able to work this into your schedule today. So before we get into what you guys do, your background. Who are you? Where are you from? How'd you guys meet? What brought you to Bakersfield?
Oh, my. Loaded question. First, this is Shannon. Bit about me. Getting into this line of work. Got an MBA in finance, got recruited into business valuation, and that took me to London where I met Kevin.
What were you doing in London?
Having a good time. I'm originally from New Zealand, and at the end of the .com bust, I decided to pack up from what I was doing there and headed to the UK to see if I could continue my career. I was a financial markets technology specialist with a background in finance and had been doing that quite a while. Met Shannon and we moved from London back to San Francisco. San Francisco wasn't me, so I said, let's go back to London, and we went back to London. A couple of years later, we had a young daughter, and we're sitting there quite a long way from home going, what are we doing here? Yeah. And so after a trip to Bakersfield, seeing Shannon's family here, we thought, well, this seems a nice place.
Yeah, it seems like a nice place. Okay.
And so, we a year later, we packed up and shipped everything we had. And
so, being that you've been all over and you're here, how long have you guys been here now?
6 years.
6 years. What do you think of our community?
The community's been great to us. It really has. I mean, we're two unknowns. We had some very fortunate introductions to various attorneys and CPAs, and they trusted us, and we got started. The professional community and the business community have been very good to us, and we have good feedback about our work product. But it's the community's been really good to us, so can't fault it at all.
David, I think Shannon and Kevin hit Bakersfield back at a great time, because I think there's a huge void, from valuation professionals, and so when they came back, and of course I think they did a great job of getting out and meeting those right CPAs and attorneys and making those connections and marketing their business, and they've done a great job. My own firm has used them a number of times, and so they're one of the names that keeps coming up when we're talking about valuation. So it's perfect from that perspective. So.
Thank you.
And I'm not sure if I mentioned, I know when I go to record later the intro stuff, that your name of your organization, Central Pacific Valuation. So everybody does know that. So I guess for our listeners out there that don't know, what do you guys actually do? You're not like valuing cars or anything like that, right? All right.
No.
Okay, all right. See,
no.
that's why I brought him.
No, we value businesses. We value interests in businesses.
Sure.
That's actually a common one, helping shareholders who are exiting, maybe buying into a business. We do sometimes value intangible assets. I see less of that work here than when I was with big firms in San Francisco and London, but used to do a lot of intellectual property valuations and things like that. Yeah, at the end of the day, we're valuing companies.
Okay, so like again, so if someone's exiting a company or someone's looking to buy a company, or I would imagine like if somebody's breaking up a company, if it's a family entity, everyone's trying to figure out.
What is the most common reason that you guys get asked to do a business valuation today?
Well, I'd say there's two, probably business equally split between these. One would be the transactions. Either someone wants to sell or they have an unsolicited offer and want to know if it makes sense. Somebody wants to buy your company and fold it into theirs, and they want to understand what to pay or what the range of values could be to them as they operate it.
Sure.
Or again, shareholders coming in and out, a buy-sell agreement being triggered. So that's one side, pure transactions. The other side is the estate and gift work. So that's the compliance work. So somebody dies and they have a private business, you need to value the interest or the total business that they own. There's a lot of estate planning going on right now. And so if somebody's gifting shares to their beneficiaries, and sometimes that's through trusts with something very clever the attorneys and CPAs do here.
Sure.
We do that. So those are the two main areas. Aside from that, smaller areas for us we don't focus on would be litigation, contentious work, or divorces.
Yeah, family law would be an issue I could see comes up periodically, right?
It does.
But that's not something you guys really deal with, or?
It's not a focus area for us. There are others who do specialize in that, and we'll do the expert testimony work, and we've decided really to just focus on our core areas.
Sure. Shannon, when are there times when somebody should be getting a valuation but doesn't?
Oh, many times. So, handshake agreement, selling a business may not be the right price. Somebody buying in without thoroughly looking at it, maybe paying too much or too little.
Sure.
Probably too much is what you want to worry about there.
If you're the buyer, there's no such thing as too little, but right.
Yeah, those would be the other thing. Buy-sell agreements, when you have partners coming together forming a business, or they already have a business going, but they don't have a good buy-sell, and that's actually more common than you would think. That's a good time to get a valuation when you're doing the planning and you have a baseline, so all the shareholders know, okay, this is what it's worth today. These are the buy-sell provisions if something happens and somebody is leaving the company and the expectations are set. That very rarely happens, and it should.
One of the things that you're doing valuations is, I was actually looking at a valuation that you had prepared recently, and one of the things that's always comes up is this issue of discount rates, right? And, we were sitting there listening, waiting for the Fed to make their decision today as what they were going to do with interest rate policy. Interest rates have swung very drastically over the last few years, kind of up and down. Does that have a big effect on what you guys are doing from a valuation perspective?
What's a discount rate first? I don't tell you.
So let Shannon tell you that. I know what it is, but let Shannon tell you what it is.
Shannon, tell
So
us.
the discount rate, or as you see in our reports, sometimes we call it the cost of capital. That's really the rate of return on a business's cash flows to an investor. So it tends to be more stable than you would think. Yes, we've had all these fluctuations over the last 15 years in the federal funds rate, other target discount rates, but we're also looking at long-term equity returns going back 100 years, and also any premiums for small companies. So the overall discount rate on equities doesn't change. Like, it's not as volatile as it is, say, for bonds. So it is, especially for private companies and around here where you have that middle market, say $5 million up to $250 million in revenue companies. It tends to be reasonably stable. It's more about the individual risks to that particular company that will impact the discount rate.
Yeah, so let's talk about that a little bit. So ultimately, that's kind of that expected rate of return somebody might get, right, in value
Exactly.
in investing in that business or selling that business, whatever. What is a common number that you might use when you're doing that?
There's always a range. So for companies, and we're talking all kinds of sizes, industries, and we know some of the industries here face a lot of risk, regulatory risk, and other farming, oil and gas.
Sure.
It could be, and we're just talking the return on equity. So that could be anywhere from 15 to 25%. Generally, it could be outside that range as well, but that's common range.
Right. So when somebody's buying a business, for example, or somebody's valuing a business, so then like to use that number 25%, that's that kind of expected rate of return in theory, that when they're purchasing that business or buying that business, in theory, that would be the rate of return they might expect to get based on that, purchasing that business at that valuation amount, right?
That's correct. And that's on the equity, again, because some businesses operate in industries or particular businesses where they have no debt. So it is all equity financed.
Sure.
And that's your rate of return.
Sure.
Some businesses need a lot of debt to operate. They may need a lot of trucks or infrastructure or cold storage sheds, things like that. They could have a lot of debt in the capital structure. They might be 50% debt, 50% equity. And so you have to figure in what's your cost of debt, which is lower than equity generally. So you have that blended, that weighted average cost of capital to think about.
That blended rate. Can you give us some examples of how something might swing in value one way or the other in any particular environment?
One example would be companies that do have a lot of debt. So that makes the equity value much more volatile. It wouldn't take much of a change in their earnings and projected earnings to get a big swing in equity, because if they're sitting there and they've somehow got 75% debt in the capital structure, it doesn't take much for the equity to swing several $1 million either way.
Because the equity portion is so small from that perspective.
Exactly, and we do see that.
Obviously, when you're doing this, you're working off of financial statements that some CPA firm or somebody is providing to you. And obviously, that'd be some nice, clean, neat set of financial statements and tax returns.
In theory.
In theory, right? How often do you get that?
Oh, I'm looking at Kevin.
Oh, probably about 50% of the time.
Okay, good.
Yeah.
Well, good. That's 1 out of 2, right? So it could be worse from that perspective. So,
well, we get the tax returns, and that becomes our default because we know the CPAs have gone through those. The management prepared financial statements, you never know what you're going to get, and not enough companies hire CPAs like you, John, to do the compiled or reviewed financial statements, or even the larger ones will get the audits because their banks require it. And you do see some of those reviewed financials that banks will require. But I think it's good practice just to have a accountant's compilation every year, especially if you're looking to sell your business down the road. You have something clean to show a buyer, but it's challenging. Sometimes we get larger businesses than you would think. Kevin often deals with those where they're still using QuickBooks. They've outgrown it. Chart of accounts has gotten out of control, and it increases our scope just to untangle that.
So tell me about that a little bit. I know that you two obviously are working in the same organization doing different things. What roles do you each fill?
We do the same thing. We both do our own projects. So the way we do it, we each, a client engagement comes in and one of us will own it and we'll be the primary report writer analyst, but we attend all the meetings together, stay involved in the correspondence. So the other one is really that reviewer at the end of it all. So we do, even though we're small, we do have that quality control process, which I always had in large firms.
Sure. Yeah, I got that review process that somebody kind of double check you, make sure that you're doing that. You said you get 50% of the time you get clean financial statements. The other time, the other half, you're not getting clean financials. Is somebody cleaning that up after the fact before you guys do that valuation to try to make adjustments to that, or what do you typically do?
No, it's the short answer. So
is that your role? Is that what you guys do, or
we do our best to unpack those management accounts and try and get them aligned as closely as we can, as practical to the tax return. Obviously, the tax return is going to be a little bit different due to, whether it's a cash-based account or accrual-based accounting.
Sure.
And, the CPA adjustments at year end. But we do what we can do with the management accounts. If they are glaringly bad, we give up and work off the tax return. And
there have been instances where we've gone back and there were large enough companies where we asked them to go get a compilation of the latest year of the financial statements from their CPAs for us to continue our work.
Okay.
Yeah. I have to say this, I'm listening to you too, and I actually have a little minor background in business valuation, and it came because 100 years ago I worked for a business brokerage firm. And so, when working for the business brokerage firm, we always had to go through that process to come up with some estimate as to, what that market value might be, right? And because I've done that, and because I sit and work with my clients, I always look at their financial statements, and I see too many tax returns that are either my own or from other firms, and they're just not as clean as they should be, right? And they're just not. And candidly, I got to tell you, I'm not even sure that the compilations are either. They should be. They should be, but that doesn't mean that they are necessarily. I'm not sure that all those accounting firms are going through that process to say, hey, I'm going to clean this thing up and have it be that, that perfect representation of what results might be so that Shannon and Kevin can do their valuation work. It's just, I just don't think that happens. So there are business brokerage firms that do valuations here in Bakersfield. So like Sunbelt Business Brokers, right? I'm sure You're familiar with those guys. They do a valuation, but I think that's for sale purposes more than it is for anything else. Would you agree with that?
That's true.
Yeah. So how might their results vary from what you guys might do from that perspective?
It's a really good question. So there are two ways of looking at value in terms of there is like a fair market value. There's more than two ways. Sorry. There's fair market value.
Right.
That's the willing buyer, willing seller.
So is that market-based approach then?
That's a really, again, good question. We're using finance theory, so capital asset pricing model, typically to value a company. And that's appropriate for companies that have, at least $2 to $3 million in revenue. For smaller companies, sub $1 million, you really want the transaction data. And that's where Sunbelt excel. They work, I think, quite a lot in that sub 5 million, sub 1 million market.
Right.
Definitely in the sub 1 million, you do want to look at the transaction data. It doesn't make a lot of sense to try and apply a finance theory to that sort of business, particularly for transaction purposes.
Sure.
And even though there's not a lot of publicly available transaction data on small companies and those multiples, big firms like Sunbelt have their own internal databases. They know roughly what things are selling for in this market or in the California market, and they can even check if they wanted to look elsewhere in their national network. So, yeah, they're well positioned for those, really the smaller and the Main Street businesses.
Yeah, I want to go back, and I should have done this earlier in the conversation because we've got a little bit technical, just so that our listeners can understand. Tell them about the value, the valuation process, and ultimately kind of some of the steps that you go through to then ultimately arrive at value. So what would that look like if somebody wanted a business valuation?
Sure. Well, we'd gather a lot of information first, and we've touched on that. The financial statements, tax returns, corporate governance documents, say your bylaws, shareholders agreements, operating agreements, just to understand rights and preferences of the different shareholders. And from there, we'd review all that. We'd have management interview or two and just understand qualitatively, what does the company do? How do they make money? Are there risks in their customer base or in their supply chain? What's the outlook? Do we research the industry? We look at current economic conditions. So we're looking at a number of things that could impact it. And ultimately, at the end of the day, business valuation is forward-looking. So after we've looked at the past and considered that and what they're doing now, we talk a lot about the future and where they're going, what their plans are. And we work with the management forecast.
Shannon, interrupt. How many years of data is good for you to have to be able to kind of come to some sort of conclusion?
We typically ask for 5 years.
Okay.
It really depends. We have worked with companies that completely changed their operating profile. So and they changed it last year. So looking at anything before that doesn't matter.
Right.
Others, if they're cyclical and it's a long cycle, you might want to go back 7 or 10 years occasionally. So that does change, depends on the company, but 5 years is the starting point.
And so from that, you're trying to arrive at what might be called some sort of normalized earnings stream, if you will?
Yes. Looking at Kevin.
Yes. Well, what I was going to say is absolutely. So we are trying to get what is the cash flow to the business. After we've established that, we will then make some adjustments for non-cash items, such as depreciation, amortization. We'll adjust back depreciation and then...
Going with working capital requirements.
Working capital requirements, make further adjustments there. Then we have a number which we can then apply the discount rate to, and then we will add cash and then subtract debt.
Yes, to get to concluded equity.
Yeah.
I've finally got some questions. So start answering those questions. So what is your sweet spot client? What's your ideal client you work with?
We do like to, where we believe we start to add a lot of value, excuse the pun, is when businesses have a turnover of at least $5 million.
And that's, in American, that's revenue.
Revenue,
Sorry.
Yep.
So 5 million and up is where we believe our services do add the appropriate amount of value. The client is less fee sensitive. Somebody with a $500,000 business doesn't want to pay thousands of dollars for a business valuation.
Sure.
In addition, when they have that sort of revenue, they tend to have better management structures in place. They have better accounting practices in place. The financial statements tend to be a lot cleaner. And the business owner or owners, they tend to have a better perspective of where the business is and where the business is going. And so there's a bit of maturity to the business.
Yeah.
There's some size and efficiency to the business, and they've got some structure.
Yeah, makes a data. If you're listening, it makes a data cleaner, right?
Yeah.
That ultimately they're going to do their work from, and that business that's generating $5 million in revenue, probably understands the value of that valuation itself, the value of that product.
Yeah, and I think actually there's one thing I did want to just come back a little bit about the transaction space. So, and what I was trying to cover in that, there are two types of value that we can look at. One is that concept of fair market value, and that's a neutral type of valuation. Everything being equal, this is what the business is worth. Then there's that investment value, and that's where things can get quite interesting. So, what is the value to an investor? Is it a financial investor or is it a strategic investor? Sure. And one of the things that we look at in transactions is what's the company worth at that base level, but what could it be worth if somebody's coming in? Can they take costs out? Can they inject capital into the business? Can they expand the market share? So there is a range of that value. So that's where I think when we're looking at the transaction side of business, we can add significant amount of value because we're not just saying, hey, it's worth this, but potentially it's worth that to the buyer. It's like having look at somebody's, in a poker game, you can almost see the other person's cards.
Yeah, no, listen, I get that. I have a client that's in the process of sale right now, and it's always mixed emotions when I have a client that is selling because somebody that I've enjoyed a relationship with and enjoy the business relationship that you have with them, but you want to see them exit successfully, right? And so I'm listening to the client, and he's going, hey, I'm going to get 9 times EBITDA is the number, and in my mind I'm going, oh, that seems optimistic, but that's a strategic buyer that's probably coming in that particular circumstance and is paying up, if you will, for some of that earning streams because there's efficiencies between the organizations, right? So when you guys are doing that, you're doing that as a buyer's representative then and looking at it from an investment perspective or a buyer's perspective and trying to help them understand what might be possible then.
Yeah, and we will do it both ways as well. So we will also look from a seller's perspective. And again, it just gives them an idea of how much they can negotiate.
Sure.
Right. An example of that from the seller's perspective would be a seller who's maybe ready to retire, has slowed things down, but there's a lot of capacity in the business. They just haven't wanted to deal with replacing staff as they left, but there's a lot more to the business. So we will give them that fair market value, what it's worth today as they're operating it, but also talk to them about what did you use to operate it at full capacity? Is there the demand? Are there buyers out there who will do that? And we'll run some scenarios. So that's the investment value.
Changing
it's value
systems
to
and processes,
specific buyer.
adding more technology. I mean, there's so many other things that can make that. The old guy didn't want to do that anymore. Or didn't want to think about it.
Yeah,
absolutely.
exactly.
Or there were more client accounts they could easily go get, but he just didn't feel like doing it and having to hire people to fulfill it. But another buyer might do that.
What's a valuation cost? I'm sure it's all over the board, but is there a range? I mean, the corporation could expect or business could expect to pay for something like that?
That's $1 million question. There is a range. I mean, it really depends on the scope of the engagement. Okay. So, maybe at the low end, it's maybe $8,000 to $10,000. At the high end, it could be a multiple of that, depending on the complexity of the business, the number of operating companies within the engagement scope. Yeah,
the type of engagement, because there are different types of reports. As Kevin mentioned, there's what we call War and Peace, which is the full opinion of value, and those are usually for the if it's going to the IRS, estate, or gift, you have to write it to a level a third party reader can pick it up and know everything about the company and industry. If we're just doing it for the business owners or for the company, we can do what we call a restricted opinion, same amount of valuation work, much shorter report, because they already know what they do. We don't have to write an extra 50 pages about it. Gotcha. We do estimates of value or calculation engagement in CPA jargon, where that is flexible. It's not an opinion, and we're not bound to any specific standards, and it's really pure consulting. Whatever we agree on with the client is the work product we'll deliver.
Where do you get your clients then? Is it the companies contacting you, or is it banks contacting you, CPAs? I mean, lawyers? Where your leads come from, I guess?
Most of them come from CPAs or attorneys, either from the attorney on the client's behalf, or the CPA will sometimes contact us and get it going. Sometimes the clients call us directly, but we've been recommended by one of those advisors. Sometimes we have recommendations from other folks, from wealth advisors, bankers. I think Kevin, to see if you remember anyone else.
Or
word of mouth. Some business owners talk to each other, and sometimes word of mouth from
So if someone's looking
clients.
to get an infusion of capital through their bank, a bank might reach out or recommend you guys that, hey, go talk to these and really find out what you're truly worth before we go loaning you money, or no. I don't know.
No, I mean, the banks have their own resources they have in terms of how they're going to assess the risk and the value of the business.
John had one question written down here. So if you were going to give some advice to someone on what they might do to increase the value of their business, what would that be?
And we're looking at each other. There's a few
wow.
things.
There's a few.
No, it's like, where to start?
Well, I think, to me, one of the key things, one of the best investments you can make into your business is your information systems, particularly your accounting and financial controls. Without making that effort, making that investment, you're sailing blind. It's just not good. So, I'm a broken record about this. I think it's really important to have a really good relationship with your CPA and figure out how to run your books. And I can't stress this enough. And it starts right at the really beginning, which is even with your chart of accounts. Define your chart of accounts so you're consistently recording where your expenses should go, and don't have 300 categories, one with like 50 cents in it. That's is no value to anyone. Okay. And also, you can understand, your revenue streams, what your gross margin is per revenue stream, and stuff like that. But it's really important to have that. Find a good CPA, like John. Get your books in order, structure them well. With that information, you have a lot of power, and you can do a lot of analysis on your accounts, and you can then target where to make more money, where to cut costs, where things are winning, where things are losing. But it's got to be in your information systems. That has to be your best investment.
David, I'll add to this, and we've been talking about it a little bit, but, a buyer, from a buyer's perspective, a buyer ultimately, I think, can determine what value might ultimately be, specifically in a sales situation. But, what a buyer wants to see is they want to see history of a business that has a very solid revenue stream and net income stream, right? So that we can arrive at the right cash flow, right? And we see that number, from a historical perspective, that it's relatively consistent, right? So my profitability is in some range and ideally growing, right? Maybe growing rapidly. And then we want to see, clean financial statements. That's what Kevin's talking about. We want to see so that we're not casting doubt on the financials. We're not casting doubt on the organization. Everything is there, makes sense, looks clean from that perspective, and you can see the right results in the financial statements. One of the things that I see, Shannon, Kevin, I do too much small local business, right? And sometimes I see junk that's in the financial statements. It might be, a husband and wife that own and operate the business, but then maybe there's 2 cars in the business and some of these different things. And so that degrades earnings, right? All of a sudden they're not as profitable as they really are because, they might be running somebody's automobile expenses through the business. So nice, clean financial statements that, you've got a proven earnings stream. You see revenues that are growing. David, I always tell my clients that they want to sprint through the finish line. If you think about your exiting, you want to be pushing that business and growing revenues and growing profitability and doing everything that you can, because that's going to be exciting for somebody that's going to be that buyer, right? That buyer is going to come in and see a thriving organization that provides a lot of opportunity for them. I think there's too many business owners that get to be, retirement age, if you will, and then they start to slow down, what Shannon was talking about a little while ago, where they don't have the ambition necessarily to go out and chase that next customer, chase that next process. And so then revenues either stagnate or maybe even decline, and that business could become unprofitable. And then that buyer wants to exit, a business when it might not be as appealing as it could have been otherwise. So, ultimately business valuation, or, Shannon was talking about, intangible valuation, right? In order to evaluate intangibles, and Shannon, please comment on this, there has to be some sort of cash flow associated with that intangible, right?
Yes, absolutely.
Yeah.
And the businesses around here, I just having done this work so much in my prior life with big firms, when we look at businesses here, even though we're valuing the total company, I'm thinking about what's the group of assets that forms this company that creates the value, and how do they work together?
Sure.
And you've got everything on the balance sheet you know about, your fixed assets and your working capital, but you might have technology, and that's how you earn your revenues. If you have a technology platform, you might have a brand that everybody knows, and that's driving people to you, and customers. That's a big one here. Your customer relationships, how long your customers have been with you, what sort of customer turnover, attrition do you have or don't have, which is even better. So we think about what are the intangibles that drive value, because at the end of the day, we're coming up with the total company value, but that value encompasses all the assets.
Yep. Shannon, obviously you guys, at least in the firms you're working for in San Francisco and London, I'm assuming patents sometimes, had some involvement with that, right? But ultimately, that comes back to some sort of cash flow stream that has to be associated with that. Is that not correct?
Absolutely.
Yeah. David, the idea behind valuation, and this has nothing to do with what we might call, say for our residential home, right? The house that we live in. But anytime you go over into the investment world, whether it's investment real estate or business investment or anything else, it's all about what's that cash flow stream that ultimately is associated with that particular asset or that particular investment. That's the question, is what's the cash flow? And then the second part of that is what rate do we use ultimately to capitalize that, or what discount rate do we use, right?
Yes.
It's simple, but it's not easy, right? I guess, as they say, conceptually it's simple, and that you're trying to determine this cash flow stream is part of it. And then the second part of it is what's the appropriate rate to use, the investment rate of return to use to do that. And so it sounds simple from that perspective, but it's not. And then that's why they have profession, right? That's why they're professionals.
Right. Yes.
That's why we have you guys. Awesome.
Right.
Just touch on earlier what you guys said, you guys being new to the community because we got a lot of business owners and stuff and small to large that listen to the podcast. You come in new, what are your recommendations for someone coming into the community and getting involved? How did you start building a relationship? What did you guys do to kind of get known?
I actually started about 6 months before we moved here, and just through my network. And again, my family is here. I'm a Bakersfield native. I left to go to college and hadn't lived here since then, just coming back every 3 or 4 times a year to visit. So just meeting people, looking people up in my professional networks, alumni networks, find people here. I just made contact, and also my family was good with introductions. So I'd already had a fair number of conversations before we got to town, and then really hit the ground running. The first couple of weeks we were still in a hotel waiting to get settled in a rental home and get, our things were in a container coming from the UK, and we were going out and having meetings, and people were interested to know what we did because it was a gap in the market here, and people were happy to have us. And there was a curiosity, like, you came from London, what are you doing here? I said, "No, I'm a native." "Okay, what high school did you go to?" And then I'd tell them, and then it'd be okay.
Yeah. We got a couple rapid fire questions for you here. What is, I'll pose it to both of you, what is something nobody knows about you? Kevin?
Okay, so a few years back, I went and ran a half marathon called the Midnight Marathon in Tromsø in Norway, having done very little training, and still managed to complete it in around 2 hours.
Fantastic. Did you lose a bet, or what caused that?
Did you lose a bet? Okay, here's the real question.
Actually, a friend said, you can do it. Come on.
Yeah.
Well. Whatever.
Yeah, right.
And you did it. Way to go. Shannon, what's yours?
I'm a classical musician, and actually thought that was going to be a career path. When I left here to go to college, that's what I thought I would be doing. Life changed in college, and I still play. I don't perform anymore. I haven't since our daughter was born. Just there's a time, lack of time. But I stay involved other ways.
Violin?
Yes.
Yeah, I remember that past conversation. What's the best advice you've ever received?
Oh. Actually, yeah. When I was working at PricewaterhouseCoopers, chatting with one of the directors there, I think it was just approach things as if you had nothing to lose. Just be fearless about things.
Come on, Kevin, what's yours? Run a marathon when asked.
Oh dear, you put me on the spot.
I did.
There are two sayings that I really like, and to answer your question in not a particularly good way, but my two favorite expressions are: if you're not living on the edge, you're taking up too much room. The second one is never miss a good opportunity to shut up.
Is there anything you guys have not told us that you'd love to tell us about the practice and what you do and about you guys before we let you go?
I don't know. I mean, we really enjoy our work and working with the business owners. I mean, obviously the compliance stuff is not always fun. On the estate side, it's a challenge for a number of our clients for obvious reasons. The gifting work is good. It's helping people structure their affairs. People should be more conscious of that, particularly with the gift and estate limit sunsetting in the next couple of years.
Right.
But also helping business owners understand their business. What is it worth? The question is, what could it be worth? Well, here's what you need to do. And really, I think, helping business owners understand what their business is worth. They don't always agree with us, but that's the nature of what we do.
Sure. I imagine a big emotional factor comes into that sometimes. Like, this is our baby. We grew it to here. It's worth multi-millions.
Yeah,
Yes.
yeah. There is unfortunately an element of misplaced expectations. Yeah. But again, it's the numbers never lie. That's the problem. Yeah. Well, that's not the problem. That's just how it is. Yeah. If you're not making money, your business is not going to be worth that much. But if it's making money, you're profitable, you're consistent, then you can expect a pretty good outcome.
Yeah, I got to tell you a quick story. So I failed miserably as a business brokerage salesperson, and when I had that job, I was let's suggest that I was probably 21 or 22 years old and in college at the time. But I had my college professor talk me into becoming this business broker, and I got it. I understood conceptually. But then it's about going out and generating leads and listings and ultimately going through that process. And so one of the things that I always used to do is I used to cold call because I was relatively good on the phone, and people didn't understand that I was a 21-year-old kid that didn't have that age and maturity behind me. And so I called a local business owner. It was an industrial pump place over off of east side of Union Avenue, and the guy was I've been thinking about it a lot. Come over, let's talk about it. And so went over there, and he had some rough financial statements, and I said, well, what do you think you want for the business? And he said, I want $3 million for this business. And he had lost money the last couple of years, and you could see, this decline in revenues, and he had no meaningful assets. I had some, but nothing that was substantial. And I said, how did you arrive at that value? And he said, well, I need that amount of money to be able to retire in the lifestyle that I want. Number one. Number two, I should have been making about this amount of money every single year. And if in fact I had, then that's the amount of money that I had. That's what it was worth. And so that's what I figured that I need. And so I was not successful with that guy, because I ultimately said, well, listen, what you need, right, has nothing to do with what it's worth today, right? And so you've got to go generate that. You've got to put that business in a perspective where it has that cash flow stream ultimately to be able to prove to some potential buyer that's what it's worth. And so people are misguided. They really honestly are as to what that business is worth. They really don't have any idea. And so it's that's why you guys exist in part, and it's good to have you from that perspective. So,
well, I really appreciate you guys doing this, and I hope you enjoyed it. And this will be airing in the next week or two. Well, if you're listening to it, then obviously it's aired. So I think that's how that works.
Yeah. If somebody wants to get a hold of you guys, what's the best way to reach out and get a hold of your firm?
They can, phone number, direct.
What is that phone number?
661-527-9080.
Okay. And your website?
Is Central PAC, PAC, val.com.
Okay. Instagram, Facebook, any of those things as well, or just the website and phone numbers?
Facebook, LinkedIn,
Instagram, we started. So, let's say Facebook and LinkedIn.
Okay.
We've already had this discussion in the past. We don't do Snapchat.
Yeah.
So.
And give us your phone number one more time before we let you go.
Sure. 661-527-9080.
Okay, perfect.
Perfect. Thanks again, guys. Really appreciate you.
Thank you.
Thank you.